there. Whether we can sort of connect while I'm in France. I don't know if it'll work. But. So it looks like it's going to work today, which is good. Good morning and welcome to our 10 minutes at 10. Now this says we are live, so hopefully all is good. So let's check and see whether we've got sound, because I'm not seeing any sound there. Are we live? Have we got sound?
Definitely live.
No, I'm not sure if we got sound. Yes, we've got sound. Right, splendid.
Big delay.
Right, okay. I know, it's huge, isn't it? Right. Okay, so welcome to our 10 minutes at 10 for everyone, and today we're going to look at meaningful cash flow. So I need to stop me talking in the background because that's getting very distracting. Oh my goodness me.
Just mute it.
Why have we got the sound there?
Just do it. Put it down.
Let's just mute. Right, okay. So welcome again. We're going to talk a little bit about cash flow. So it's really important to be measuring your cash flow and to be looking at cash flow forecasting, cash flow management, that kind of stuff. And it's more important to be managing how you're viewing those numbers. So we thought we would walk you through some of the reports in Xero that are perhaps a little more useful than others, so that we can see what we're looking at. We're going to show you some live reports. So let me minimize this, and I'm going to maximize that. I'm going to share my screen with you, make this large, and hopefully you can see our bloody brilliant demo company. So what we have in here, there are two key reports that we need to be looking at on a very regular basis. So I'm going to go to them through the reports menu, and the reason why is because Xero has old reports and new reports, and we're going to look at both of those, and I'll show you the difference between the two and why we are quite liking these new reports. So let's have a look at the age payables detail and the age payables summary. Now, if you click on these little stars and turn them from white to blue, it puts them as favourites here in your menus, which is why this is really quite handy. So let's have a look first at age receivables, because this is probably the most important thing that we want to be looking at. Oh, didn't want to do that. Let's go back and open that in a new tab, not a new window. Right, so this is the old age receivables report, which is quite pretty, and it's very simplified. So if you've got a lot of age receivables, this is the best place to work from. And it's really important to be keeping an eye on what invoices you've got outstanding, how long they've been outstanding for, and chase anything that's outside the current. So anything that's an older, we really don't want anything in there at all. So we need quite active and proactive credit control to make sure there's nothing in there. Ideally, you want 70 to 80% of your credit, your outstanding items to be in here. Don't want any more than sort of 10 or 20% over here, because that's just too old, and it means that we've got issues with our credit control. Now, what you can do here, which is quite useful, is click on the button and open this at invoice level. This is massively helpful for when you're looking, when you're having a conversation with your client and you're perhaps doing credit control, trying to understand where people are outstanding and why they're overdue. Now, the age receivable detail is quite nice because this is the new report for Xero, and you've got more options to add things such as the outstanding VAT, which is quite helpful. Let's add that to the end of this report here. Now, when we're looking at age receivables and actual cash in, you need to remember that the age receivables and your cash in includes VAT. So the sale is recorded in your accounts net of VAT, and the VAT element is in your balance sheet, ready for you to be collecting it from HMRC. Now, this report helps you identify those cash receipts that are including VAT. So when the cash comes in, you could, if you're being proactive in your cash management, move some or all of that VAT to one side, because although it's cash in, it's not your cash to spend. So put it to one side, stick it in a VAT account, and then make sure you pay off your VAT liabilities first. Now, if you know that for every £100 worth of VAT in, you only actually pay over, say, 50% of that to HMRC, because the rest of it you're going to recover with input VAT on purchases, then you can change your ratios. But it's quite useful to put this to one side, stick it in a VAT account somewhere. So this report is probably one of the most important reports in your Xero account. The age receivable summary is the new version of the old report. So you can see the difference here. This one just looks a little more compact on the page. This one, it's a little bit bigger. Now, the reason Xero have done this is to make sure it's easier for you to read if you're looking at it on an iPad or a tablet or on a digital screen or your phone even, rather than just in on your desktop PC. So the new reports have report settings which give you options. For example, you could add email address and primary person to your age receivable summary, which helps with your credit control. So this you can do in the new report, but you can't do it in the old report. There's no option. Although the old one does give you, if you've installed Flash, a nice little report. Gives you a little pie chart so you can see who's outstanding and what your biggest age receivables are. So in terms of cash flow management and understanding the information provided in your reports, these two reports are key for managing cash. Right, so Harry is now going to talk you through your age payables.
Lovely. So age payables has a similar kind of concept. There's a few reports, and we're going to start off looking at the age payables detail. So this works in the same way as the age receivables detail. So you can add new fields, so you can add outstanding VAT, and you can add plan dates. Now, plan dates are really, really important for cash flow because they give you an indication of when you expect to pay. But this only actually, like in these examples here, if I haven't entered in a plan date, it will default to the same as the due date.
Yeah.
So as you can see on all of these are defaulted to the due date. But if we're doing proactive cash flow management, we may go into our age payables and we may update the plan date. So this may be due on the 20th of July, but we may actually be due to pay it on the 19th. This one may be due on the 15th. We might actually be due to pay it at the end of the month. So it makes a big difference for our cash flow management because it changes the timings considerably. And then if we know when we've planned to pay, we can stick to those plans and we can factor it into any cash flow forecasting.
Now, if you find that you've got more cash that you'd planned to pay, but not enough cash coming in, you can then revert back to your age receivables reports and start chasing your age receivables to get the cash in earlier because you've made promises to pay cash out to your suppliers. So super important to get the right balance between those two reports.
Yep, definitely. And likewise with the age receivables detail, we can isolate any VAT on the invoice. So this £1,200 here is actually inclusive of £200 worth of VAT. So for a cash flow perspective, this report makes a big difference because when you're just looking at an age payables report as a summary, not all payables will have VAT, such as Suffolk County Council. Yeah. But obviously this is a rates bill, so we need to be considerate that this isn't going to be paid in a lump sum. It's going to be spaced out over, say, 10 payments, 12 payments, whatever agreement we have with a customer. And of course, in this case, with Suffolk County Council.
Yeah, so here you can see that what we've done is put the invoice date in as 15th of March, but the due date in as 31st of January 2020. So it's probably going to be, that'll be the last date that the direct debit goes out.
Then moving on to our age payable summary, this is basically, it's literally a mirror image of age receivable summary, except looking at your payables perspective. Now on this one, likewise, this is a bit more of an expanded view. It's a bit more user-friendly for users who use iPads and mobile phones. And actually a really good one here is it also includes any expense claims as well. So if you do have staff members who are submitting expense claims, we can see these down here. And it luckily separates these out as well. So generally speaking, expense claims get paid fairly promptly. So it's quite good to have this isolated out so you know exactly what is due to staff.
And obviously this is a summary. So because this is a summary, you can't add the same payment due dates. You have to do that from the detailed reports. So this report is really useful to give you an overall view of how much is owed to people that you're trading with and when that cash is likely to be due. Whereas the age payables gives you the absolute, this is going to be due, on this date, and you can do your cash flow forecasting with it.
Yeah. Which
leads us quite nicely to the executive summary. So Harry's just going to go through accounts, reports.
That's it. Here's one I presented earlier. Have a look at the executive summary.
Now, this is the report that doesn't get used that often, which is a shame because it's actually quite a useful report. Now, Xero gives you an awful lot of core information, particularly on cash, that can help you understand how your business works. So it does only compare this month versus last month, but it gives you a nice variance. So if we look at this top section, you've got cash received in the month, cash spent in the month, and therefore whether this is a cash surplus or a cash deficit. So the thing with cash surpluses and cash deficits is sometimes that's okay. It might be that you're expecting a deficit because you've got a lot of money to spend on stocks and inventory at the moment, but you're expecting to recover that in a big sale that you're making next month. So you might buy your stock in July and get your invoice paid for in August. But so long as you're understanding why you've got these deficits and the deficits are explainable and they're acceptable and manageable within your cash flow forecasting, that's fine. So it might be that you've got plenty of surplus in your actual bank account, which you can see we have here. So although we've spent out more money than we've received in, we had £19,000 in our bank at the end of June, and now we've got 10,000. That's still okay, so long as we know, we're talking about our run rates and our break-even points yesterday or earlier on this week, so long as we know that we can cover all of our other outstanding liabilities. Now, let's just pop over profitability and balance sheet. Ignore those for a second. Let's come back down to the bottom. More indicators for cash flow management are down the bottom. So here we're going to look at average debtor days. So this is how many days does it take your customers to pay you. So last month it took them an average of 21 days after the due date to pay their invoices. This month they've slipped a bit and it's taken an average of 39 days to pay their invoice. Now that could be just one customer paying late. It could be a multitude of reasons. There could be many good reasons why they're paying late. But if that becomes a negative trend and maybe next month it slips to 50 days and next month it slips to the month after it slips to 70 days, then you need to be looking at your credit control because something's not working there. Conversely, our creditor days are how many days it takes us to pay our suppliers. Now, generally, you want your creditor days to be more than your debtor days. So you want to collect cash in faster than you pay it out to your suppliers. But not to the point that you're upsetting your suppliers and creating bad relationships. So in this example, we've got 64 days that we took to pay our current creditors for last month. But this month it's extended to 169. Now on the face of it, that looks really, really bad, but it's probably due to our rates bill, which actually isn't due and is being paid down in instalments. So one way around that is rather than creating one rates bill, you could have 12 rates bills, one for every month with the correct dates on there. So we do have clients that have done that in the past. We tend not to do that. We tend to accept that we have one rates bill. We know it's going to impact our average creditor days. But if the average creditor days is important to our client to measure, we would then take that rates bill and separate it. So you have to understand how the information in your age payables can impact your average creditor days if you're relying on that information to measure how successful you are at paying your suppliers.
And that's the thing with Xero as well. All transactions will impact, well, most transactions will impact your cash reports in some way, shape or form. So it's really important to consider when you first put in the data, not just the fact that actually you've got to make sure the data is correct so you know what the due dates are, but why it's so important to get due dates in, why it's important to look at, say, rates bills that are paid down over 10 months rather than over 12. And it just gives a bit more depth to it. And I think actually a lot of the times what we see with Xero is if someone's inputting an invoice, they sometimes forget about the impact it has on these cash reports. And then sometimes what happens is the cash summaries and the executive summaries and that sort of get a little bit brushed to one side just because the information isn't there in the first place. But really, really useful. When you've got the information there, these reports have a lot of power and they can really just help get a bit of an understanding on where you're heading.
Now, another quite nice little report or little line in here is this short-term cash flow forecast. So the short-term cash flow forecast is telling us that we've got more cash due to be paid out than we have to be paid in. Now, this simply looks at age receivables less age payables, so it doesn't take into account things like your PAYE that might be due, or your VAT that might be due, or your salaries that you might be paying staff. But it's an indicator of your short-term cash liabilities. Now, another report that we find quite useful is the business performance report. Now, this is relatively new, and we don't find that many clients actually tend to look at this or pay much attention to it, but it can be quite useful. So we looked at the debt ratio and the current ratio earlier on in the week, but if we scroll down a little bit further, the working capital to total assets is quite an interesting one to have a look at, and the fixed assets to net worth ratio. So they use the figures as they stand at the point in time of running these reports. So they are interesting, but if your figures are not up to date, you might have invoices that are not raised, or your bank rec might not be up to date, then these aren't going to be quite so useful. But let's have a look at the working capital to total assets ratio. So this looks at last month versus this month, and it's looking at our net working capital, which we decided earlier on was?
Basically, sorry, froze gone. Net working capital was essentially, if you took all of your assets and you paid off all your liabilities tomorrow, it's basically what you have left with to play with. So that's what net working capital is. It's free-flowing cash, essentially, cash you can utilize. That's, of course, assuming you could collect all of your cash tomorrow and pay all of your liabilities tomorrow. But it's actually really key because it gives you a bit of freedom to understand what you do have available to play with. So we can see back in July 2018, there was not very much net working capital available to us. But now we've had this steady increase, we've had this steady growth. So it actually means we've potentially got cash, which we could be utilizing elsewhere in our business. So it might just be that actually we could be putting this to better use than it is currently. So really, really nice little, it's a nice thing to know actually in this case when you see it increasing.
It's a nice indicator when things are going forward. When things are going the opposite direction, it's also a good indicator to tell you that the general health of the business might not be what it ought to be. It may just be that your data is not up to date and just needs reconciling. It could be an indicator of something else that is happening in your business that you need to start taking action on to rectify. So in this instance, you can see that the total assets are growing during the period and that the net working capital is growing in its percentage, which is good. So this company is probably turning over more sales, it's probably generating more income, it's probably spending less money and making more profit, and therefore has more cash and therefore more net working capital. So this is what we're really looking for. Now, if you look at June 2019, I don't know if you can see that because this... on our screen,
let me see if I can get nearer down there. It's going to be tricky.
Yeah, what you need to do is click on this little button here to move that toolbar at the top.
There we go.
Yeah,
I was worried I was going to close it.
See this.
Just so people know, there's a microphone, which is why we're doing all of this.
Yes. So what we've then got at the bottom is a minus 334 net capital. So that's probably an indication of a big cash outlay that we need to go and have a look at. So for the purpose of this demo, we're not going to have a look at it and try and figure out why. But this is an indicator, if this was happening in your business, that you need to go and have a look at your business and see what's happening. So that was a whistle-stop tour of cash management and cash analysis in Xero. We hope you enjoyed us. Thank you for joining us today, and we hope you enjoyed the video. Please let us know in the comments, and if you have any queries about that video, please also let us know, and we'll try and answer those today. So we've got lots of payroll and MTD stuff to finish off today, so we might not be as responsive as we'd like to be, but please bear with us on that. So thank you for joining us today, and we'll see you next week. Bye for now.